Hello and welcome to Meet Kevin Report on number 21. Today is 121. Today is CPI Day, and it is also the first day that we're going to try streaming on YouTube, Twitch, Twitter, and Twitter Spaces. I don't know if that's even possible, but we're trying it. We're trying to go for Twitter and Twitter Spaces. So you have live video separate from Twitter Space. It'll be really cool. So we're going to try both, and then maybe we can even bring some people in from Twitter Spaces. But first, we've got to talk about the UPS Teamsters crisis that's going on. I have to say, a course member hit me up about this a few weeks ago, and when I first heard about it, I'm like, okay, we've all heard of strikes before. Strikes come and go. They're not great for individual companies because obviously they end up costing more in terms of labor. They're usually not excellent for employees either because they then have a more contentious relationship with their employers. Nobody ends up feeling like they really won out of them. And even though employees tend to win with higher wages, again, the contentious relationship can often lead to layoffs and other problems. So the problem with this is not anymore that this is just a regular strike, though. When I actually looked at the numbers, I started realizing, this could be a little bit more of a problem than maybe initially we gave credit to. And the reason for that is just the sheer size of UPS and the implications that UPS could have for, the SC word, supply chains. Not great. So listen to this. Here's an email on July 5th from the UPS Teamsters Union. They wrote the following with a big picture of their entire Teamsters, at least the people who showed up for, I suppose, this event. Anyway, it says here, around 4 a.m. Oh, okay, I wasn't expecting that one. Around 4 a.m., UPS walked away from the bargaining table after presenting an unacceptable offer to the Teamsters that did not address the members' needs. The UPS Teamsters National Negotiating Committee unanimously rejected the package. Following negotiations, UPS refused to give the Teamsters a last, best, and final offer, telling the union the company had nothing more to give. And keep this in mind, the Teamsters Union is arguing here that they are simply asking for a last, best, and final offer beyond what UPS is saying was already their offer. So it's kind of something that you see in real estate as well, where you'll write an offer as a buyer and be like, all right, look, your place is listed for $450. I'm coming at $430. The seller's like, I'll take $445. Buyer's like, I'll go $440. Final offer. And the seller's like, give me one more last and best offer. And you're like, hey, that's it. And everybody just gets really frustrated and entrenched. Anyway, that kind of sounds like somewhat what's going on over here. Obviously, to a much greater scale with the impact of many, many more people. In fact, up to potentially 340,000 people. That's more than a quarter. That's more than a third of 1 million people. It's insane. All right, so what do we have here? Quote, the multi-billion-dollar corporation has plenty to give American workers. They just don't want to, says Teamsters General President Sean O'Brien. UPS had a choice to make, and they have clearly chosen to go down the wrong road. The UPS Teamsters contract, covering more than 340,000 full and part-time employees, expires July 31st. That's in about 2.5 weeks. That's actually right after the next Federal Reserve meeting. No additional negotiations are currently scheduled. Also not great. The Teamsters have repeatedly made clear that UPS members will not work beyond the expiration of the current contract. In June, a rank-and-file UPS Teamsters authorized a strike, but overwhelming 97%. All right, that also already made me a little bit nervous because when I read that part, look, it's very common for parts of a union to say, let's strike. But then when you get actually down to the union level, people are like, look, do we really want to strike? Look, we're okay with this offer. Clearly, if 97% of folks in these unions are saying, no, we're not okay with these terms, clearly there's a high likelihood here of a strike, which means either UPS provides a better offer or a strike happens. And the last time a strike like this happened was in 1997. In 1997, UPS basically stopped being able to deliver packages for 15 days. It cost the company in 1990 $7, almost $850 billion. The crazy thing is now UPS is probably even more vulnerable because you have a whole lot more competition. It's not just FedEx or the USPS, but it's also the fact that you've got companies out there like, I'm just going to say it, Amazon, that are like, please give us more of a reason to be able to raise what we could, essentially, hire workers with. And if we have a larger worker supply, then maybe we can actually get experienced workers faster. Now, I'm not sure if Amazon is looking to kind of recruit from UPS, but it'd be very interesting because you potentially end up having this larger shift of individuals from UPS to maybe other companies, especially if these individuals do have to go on strike and they get frustrated with the ultimate resolution of this. I do expect there will be a resolution, but the bigger problem will likely be not so much the benefit to the other shippers, the DHLs, the FedEx, the USPS. The bigger problem is going to be, what is this going to mean for supply chains? If UPS delivers 37% of the parcel market by revenue, which is larger than FedEx by 4 percentage points, double what the United States Postal Service is, and triple what Amazon Logistics is, then all of a sudden you potentially have a real snarl in supply chains. Now, the good news is our economy does have this insulative buffer of inventory. And even though we thought that we've run through most of our excess inventory, most of the individuals most of the businesses who have gone through the last 18 months or so still actually have some degree of excess inventory. Nike was supposed to be one of the big winners in this environment, where Nike was in a position of pricing power was the idea. I didn't think this was true, and sure enough, in the last earnings report, you actually had Nike basically begging for more discounts in the earnings call. It wasn't a good look. It wasn't a good look at all. You basically had them going, we're going to be discounting. Sorry. And that's, again, because most businesses seem to have more inventory than they've had during the supply chain crises of 21 and 22. So will potentially an extra 1 to 3 weeks of delays via UPS have a massive impact on our economy? Obviously, it's hard to say. There's a real potential that it could. The places it's probably going to have the biggest issue are going to be in areas where companies haven't stocked up enough inventory. It would actually be prudent now to potentially start pre-ordering more inventory if inventory is tight and somebody is regularly using and relying on UPS contracts for parcel delivery. Maybe get that inventory ordered now so we don't end up in supply chain snarls like we had in 2021. So again, if companies have enough excess inventory, then maybe 2 to 3 weeks of a supply chain disaster with UPS wouldn't make that much of a difference because we have this available sort of buffer of excess inventories. However, it's still likely going to create some form of a hit to GDP in that quarter. And this could be bad because of the psychological implications. Imagine if the UPS strike goes on long enough and slows ordering down or long enough to where all of a sudden we have a consumption slowdown or a temporary consumption slowdown that ends up hitting CPI and ends up hitting GDP. Now the question is, okay, are we paying more for shipping rates, leading to higher core services costs, which would be bad, as well as potentially higher goods costs? So now all of a sudden it looks like inflation is reanimating on the goods side and the core inflation side. And then you end up having less GDP output just by a marginal difference, but you potentially end up going negative for Q3, which is basically what the bears have been calling for all along, that, we're going to go negative GDP in Q3. Well, now you potentially could have, who knows, but you potentially could have UPS strike contribute to the start of an actual recession, which could then become self-fulfilling once data starts coming out. So I think the issue is actually a lot potentially larger than I initially suspected, and that's my fault. I should have covered it earlier, at least about a week ago when this really started, but I'm covering it now. And what I thought was very interesting is some of the research I was looking at indicates that UPS is potentially more vulnerable to this strike now than they previously were. Now, there is this potential as well that this additional vulnerability actually means UPS would be more likely to try to solve this issue sooner rather than later. I would highly anticipate that you're going to have some really serious negotiations, probably between the 26th and 31st. And it wouldn't surprise me to see some form of near deal struck by the end of the month. And then even if maybe you get a day or two of striking, I think you'll end up seeing UPS bend, or the teams, somebody's going to bend. The end of the month is Monday the 31st. I cannot personally expect this to go on beyond August 7th. So that would be about 4 days of striking, first, second, third, fourth, and then you have the 5th and 6th of a weekend. So I find that potentially a likely outcome, that the strike ends up going away by being solved. It'll be a last minute negotiation, much like a debt ceiling negotiation that you really get in Congress. But I do think that it is quite interesting that UPS reports their second quarter results on August 8th, which is just literally a few days after when I expect this issue to be resolved. Now, personally, I want to make it clear I'm a big fan of making sure your employees are paid well, and if not even overpaid, whether that's a combination of benefits or just pay or stock-based comp, whatever it is. I'm a big fan of longer-term employees getting paid very, very well, and I hope UPS can figure this out, not only because I don't want supply chain problems and I don't want issues with the economy, but also because I think I think there's an opportunity for UPS and the Teamsters Union to figure this out. But this is definitely something that's a little bit more intense, I suppose, than potentially first thought. So I would pay attention to this over the next few weeks if you haven't yet. It's one of those near-term catalysts that just isn't fantastic. There are actually surprisingly few near-term catalysts. I was talking about this yesterday. I was saying, really, once you're, what's it called? Once you end up getting, gosh, where am I trying to go with this train of thought? Hello. Once you get through the CPI report and the Fed meeting, your near-term catalysts are somewhat far and few between. A lot of bears right now are arguing that, oh, don't worry, the election is coming, Kevin. And when the election comes, that's the next catalyst. And I always think it's funny that when bears start talking about the election cycle, it generally is a warning to me that the bears have run out of bearish things to talk about. But anyway, I do find it very interesting that at the same time as you have this potential strike, for the freight industry is technically in a recession. And this is worth considering because that's probably putting a massive squeeze on a company like UPS. And so this is where there are always two sides of the story. It's not just the employees, but it's also the actual, business model. What's going on? Obviously, any individual versus a company, it's always sort of like, hey, like an individual deserves as much help as possible. But now it's 340,000 people. I mean, it's basically a company versus a company, it feels like. Or it's a company versus a few individuals who's left, outside of this. But what we found very interesting is that parcel volumes are down anywhere between 20 to 30% across the board. I mean, freight, parcel, overnight, international, you name it, domestic. It's intense how much volumes have shrunk for shipping. To some extent, it is also possible, and this is the more, I think, sinister potential point of view, but to some extent, it is possible that, and again, this is going to sound rough, but it is possible that UPS is like, please let's get fewer employees. In other words, have some people leave because maybe we've overhired. That is a real risk here, that potentially UPS has seen so much of an earnings recession and freight recession. They're like, we are now overstaffed. We can't fire people. Maybe if we go through a strike, some people will get so pissed they'll just leave, and then they're gone without us having to fire them. Again, that sounds very insensitive. I'm just thinking out loud here about how there is that possibility that UPS hired for shipping volumes that were 2021 level, but now you're actually at 2023 dumpster levels of shipping. That's not great. Now, Bloomberg Intelligence argues that the UPS negotiation is a huge opportunity for FedEx. That not only is there let's see here, contract expires July 31st. Last time they went on strike, we talked about that, from 1997, cost $850 million. This is an opportunity for FedEx. It is, they don't believe that a prolonged walkout is likely. Okay, that's interesting. That's actually somewhat similar to what I think. I think you're maybe at a week max, a business week max for a walkout. So they agree with that. And at the same time, if we look at their earnings, let's take a look here. We can see exactly what's going on in comparison here. So look at this. Here are their revenues. This is UPS 2023. This is on their latest 10Q. And what you'll find is that your next day air revenue actually is down only about year over year here, 5% at UPS. And it's volumes that have really been getting hit, but they're keeping that revenue up. Look at that. This is actually a good argument for the union. Negative 15% on deferred, and then ground is actually positive. So even though you've had some of these volume crushes, they're actually positive on what they're charging in revenue for ground. Now, I wonder how their cost of goods sold has moved. Let's look at COGS. So we'll go over here. And oh, how interesting. So their revenue, their top line revenue has gone down 6%, and their compensation and benefits has gone down about 1%. So you are getting a bit of a squeeze here, and you're not seeing as much of a crush at UPS as you certainly are at like a FedEx, minus 1%-ish, 1.2% over here. So you see that margin squeeze there. Your operating profit, for example, at UPS was 11% in the last quarter. And then last year, you were at 13.3%. So you've definitely seen a margin squeeze here, 11.1, 13.3%. And that's probably contributing to some of UPS's frustration, along with what's going on in just the rest of the industry with volumes being down so much. They look at FedEx Investor Relations. May as well take a quick peek over there and see how they compare, because that might also give you an idea of, hey, would FedEx even be hiring en masse? I mean, how much do you need to hire in a freight recession? So that does potentially weaken some of the positions of the union workers for UPS. So we'll go ahead and just briefly look at FedEx and just see how they compare. But either way, there are some broad implications to this, to the entire situation between UPS and the union. I think this also, all of it reiterates why you have a lot of companies that are very, very afraid of unionization, whether it's Amazon or Starbucks or quite frankly, even Tesla. There's a lot of fear about unionization because unions can be very, very strong, especially when they have coordinated union vote. So if I look at, let's see, revenue by service type, and then we've got, I want to find volumes at FedEx. I don't think I can quickly find those at FedEx. That's okay. That's revenue by service type. Let's just look at their operating profit and just compare. Okay, so here's the FedEx statement. Quick look at their operating profit. If we look at 22,169 in rev, pretty actually close here. to what you have at UPS, 1042. Wow. All other things be assumed equal here, FedEx is only sitting at about a 4.7% operating margin, which is less than half of what you have at UPS. So, that doesn't add well to UPS's argument that they wouldn't be able to support additional compensation when they already seem to have an industry leading margin, despite the volume recession that they're in. Wow, it's incredible. So this gives us a really good look into what's going on, in my opinion, at least a surface level here look about what we're seeing with the UPS strike. And I would mark your calendar for the 31st of this month and really pay attention to what ends up breaking down here or coming out of this. And you will probably, again, my guess is hear a lot more about this on the 27th and 28th, which is really these are your last business days before the Monday the 31st. But I personally wouldn't want to pull it out to that low of a level or that close, rather, should I say. Yeah, I'm just looking at FedEx here. Their freight revenue, this is where you hear about that freight recession a lot, down 13% in revenue year over year. Total, let's see. Then we've got package revenue, 7%, international priority, 14%. All of these are negative. And these are revenues. So it's a sign to me that if volumes are down in the excess of 20%, pricing has come up. And it's also likely that the individuals delivering packages have seen pricing move at UPS and with the other companies like FedEx and that. So again, more bargaining power here for the workers. So anyway, we'll see what happens. So that is our segment on UPS and what it could potentially mean for the economy. All right, let's now get into the next seg. Obviously, we've got CPI coming up today. That's going to be, let's see, UPS strike. There we go. That's the big deal that everybody's waiting for. We are about 46 and a half minutes away from CPI. I'm excited about the CPI, as are most folks, mostly because this is supposed to be the positive CPI read, and it potentially might, for some period of time, be the last really positive CPI report. And that's potentially because you're starting to compare to base effects that are a little less desirable than what they used to be. But before we talk more about CPI, what I'd like to do is jump into the latest SPAC. I actually can't believe, to some extent, we're going back to SPAC world. This is a little bit remarkable to me. But we're back. It seems we are back to SPACs. So let's take a quick look and break down a little bit of what we can glean about this Sam Altman SPAC, Oklo. So stand by for that. All right, here we go. Quickly make a note of this. Yeah, CPI is 5:30 a.m. California time. Okay, so again, while we're waiting for CPI, let's get into Oklo. All right, here we go. Well, the CEO of OpenAI, famous for ChatGPT, is now doubling down on a nuclear fission SPAC. He's been on the board of directors, actually been chairman of this board since 2015, known the founders since roughly around 2013, Y Combinator involved in this. And take a look at this. We're actually going back to SPAC land. Now, I've got some thoughts on this, and we're going to go through it. But first, understand what's going on. This SPAC is going to take Oklo public, which is a company that's developing a small nuclear reactor. And what you could do is you could go to their website and get some pictures of this. These are all just 3D renderings. These don't exist yet. And this stuff makes me very, very nervous. I'm exhausted at looking at renderings and projections. I thought we got past renderings and projections, but no, apparently they're coming back. As the stock market's going up, SPACs are back, baby. So basically, Oklo is the idea here is that how can we produce a nuclear power plant that could potentially just supply one data center or one massive housing tract of maybe about 15,000 units or one region in a city or a neighborhood or whatever. How can we create a small footprint building with a small reactor in it and basically copy and paste these around the world? And the idea is that maybe we can spend $60 million on a reactor and end up creating a $15 million or 15 megawatt capacity. A 15 megawatt capacity based on a roughly 24 kilowatt hour per day usage on average for an American household covers about 15,000 homes. Now, we did this research ourselves, kind of trying to play with some numbers. The national average for kilowatt usage tends to be around 24 per house per day. And what I thought was really interesting is when we did the math, that actually converted to roughly whatever the megawattage is of the power plant is how many thousands of homes you could power. So if you have a 50 megawatt plant, 50,000 homes. 5 megawatt, windmill, 5,000 homes. Kind of incredible. Now, it does appear that the technology is a little bit more expensive, even at their $60 million projection, than, say, wind energy. But wind energy is really good at a couple parts of the day and not always available, which could be a downside, obviously. So you could get like a probably somewhere around a 3 megawatt windmill for around $4 million. So if I wanted to get about 5 of these, I would have about a 15 megawatt capacity for around $20 million. Well, Oklo is expecting to build these nuclear power plants right here for about $60 million a piece and then have a 15 megawatt generating facility. Now, if you could sell this at 20 cents a kilowatt hour, it might be less, but let's say you could sell it at 20 cents, it could be pretty desirable because that could generate potentially up to $20+ million in a year of electricity, gross electricity revenue. Of course, you have costs that go into nuclear fission, but there's definitely, like, the concept is definitely sexy. And so this SPAC is looking to be valued at $850 million, looking to raise $500 million in cash. And this small nuclear design setup has not actually been tested yet. They have some permits to really start getting into some of this, but they have not been tested on a super small scale yet like this. Although fission technology is pretty common. You've got fission and fusion. Fission is your common one that is available to nuclear reactors. So the technology is definitely there, just hasn't been brought down to this sort of smaller scale here. The first reactors are expected to be delivered in Idaho and Ohio. And there are expectations that perhaps there could be very large Inflation Reduction Act tax credits for these sort of reactors. Here's an example of what an Oklo 2 powerhouse would look like. Basically, for those only just listening, it sort of looks like a small, maybe 4,000 or 5,000 square foot building where you have it's just a metal frame and you have a lobby, and then you walk into this smaller room where you have a reactor sitting there that looks like it's about the size of a school bus. And this is somewhat fascinating that in the future we're probably going to have a lot more commercial or a commercial push towards nuclear, which is actually, in my opinion, great. I think it's a phenomenal source of energy. I personally am not sure about investing in a company like this because ultimately what you're doing is you're selling a commodity, right? A unit of electricity is basically a commodity. So you face competition not just from other nuclear power plants, but also from solar, batteries, wind, and then let me just almost hard stop here. Permitting, like, good luck. I mean, I do think though, where you could prove this model out, where you're probably going to start with this model, is factories in the middle of nowhere, because people don't want to live around a nuclear power plant. But if you're like, hey, Intel's building a new factory How about we just put a nuclear power plant next to that and help power it? Great. Fantastic. You know what, where this could actually be very useful? They should try to sell this sucker in Taiwan. Taiwan, as we talked about yesterday, Taiwan imports 96% of their energy. And if China blockaded Taiwan in some sort of, takeover battle, whatever, they could basically not kill a single person and just cut electricity off to the island. Like no actual like combat warfare, like a Russia versus Ukraine, just cut off Taiwan's electricity supply because they have to physically import 96% of their electricity via, importing natural gas and then operating, either coal-fired power plants or natural gas power plants. And nuclear reactors, them having their own, would be a perfect way for energy sustainability. The problem is, again, you've got a political environment that's super anti-nuclear in Taiwan. Oopsie daisy. So you probably really end up trying to build out a concept like this at factories. Again, Ohio, Idaho, it doesn't really surprise me. Idaho's already got quite a few, energy facilities, nuclear energy facilities and research. It seems like it's a great place for it. But anyway, the fact that SPACs are back, where now you're looking at, here's a company with an idea. I mean, this is really what you have. What you have is a company with an idea. And now they've been around for about 10 years, but it's a company with an idea that has some cool renderings of a power plant and an idea that's very saleable. Like, hey, we've got an energy crisis. We've got a problem. Let's make a pretty, diagram here of how we can create small power plants, and not yet a provable business model. And then they're going to essentially be worth almost $1 billion. It's kind of mind-blowing to me. Part of this, I think, is because you end up getting people involved like Sam Altman. People put their name on this, and then they're able to SPAC companies. It's kind of like what Chamath did with whether it was Open Door, Virgin Galactic, or otherwise. Now, what's interesting is Sam Altman, actually, a little bit of history on him. He invested $375 million into Helion, and that was a nuclear fusion company back in 2021. Helion is the first fusion company to sign a contract to sell energy to Microsoft, and that is expected to start producing energy by 2028, although that's much more experimental than a fission company. It's kind of incredible, though, and there are real penalties if that fusion company doesn't actually deliver energy, especially since, they haven't quite figured that out yet, which I think is fascinating because it goes to show that in the smaller nuclear power plant space, you're going to have competition between not just solar, wind, and otherwise, but also fusion. That's going to be interesting. Anyway, or Helion is another Helion. That's the trucking company. Helion, that'll be quite interesting to see how they can ramp up larger megawatt facilities. But sticking on Oklo here for a moment, again, the company is expected to SPAC. We do have actually a ticker here. I think it's Alt-C. ALCC is the SPAC. Let's see if that's, I believe that's already actually trading. Yeah, ALCC is the ticker. And then you'll see the Alt-C Acquisition Corp. It's trading for $10.44 right now. I have to say, I think, though, a lot of people are going to be once bitten, twice shy on this. Remember back in the day where everybody's like, oh, just buy a SPAC at $10. You can't go wrong buying a SPAC at $10. And yeah, no, you can. Then what happens is they end up actually reverse merging. You get this merger, and then what? You get lockup expirations, and everybody on the inside dumps because the valuation for these companies is nutso. It's kind of remarkable. By the way, if you're on Twitter Spaces and you want to request to chat, feel free to request to chat, since now we are able to remind you about an expiring coupon code coming up in 2 weeks for the programs on Building Your Wealth, not just on YouTube or Twitch, but also Twitter Live video and Twitter Spaces, which I think is kind of cool. I still haven't looked to see if it's possible that both of those could possibly be going at the same time. I'm kind of like, the show must go on, so we're going to go with the show no matter what. But that does seem like it is kind of interesting. Yeah, it actually does look like I'm live on video and live with spaces right now. How cool. Okay, so anyway, this gives us a little bit of a look into Oklo. Again, keep in mind the biggest risks to a company like Oklo, in my opinion, are going to be energy. Well, I mean, number one, hands down by far, the biggest risk, hard stop permitting. By far the biggest risk. Of course, it's the biggest risk. Why? Because if nobody permits your project, you're not going to get off the ground. You're not going to be able to scale this. Your revenues are going to be nominal for a decade or more. And it's going to be a very risky investment, in my opinion. And look, even though I'm a licensed financial advisor and I run an ETF, can't give you personalized advice here on social media. But boy, I'm definitely a little little concerned about the revenue potential here, strictly from a permitting point of view. So that's permitting. But then you've got a big gap, and your next risk is just competition from other energy sources. Now, I do think that there is a real potential that solar and wind over this next decade this could end up becoming the decade of solar and wind. Right now, I believe markets are very anti-energy, very, very bearish energy, which I think is a perfect time to actually start creating positions in companies like Enphase. Let me give you a little hint. What you should do is go look at how many microinverters Enphase expects to manufacture by the end of 2024. This is something we've been talking about with course members for a while now. You should look at how many microinverters they're expected to manufacture by the end of 2024. And then you should look at how much money per kilowatt these inverters are expected to receive from the Inflation Reduction Act. And then when you do a little bit of quick math, you can start seeing that the net income numbers of Enphase could change dramatically more than Wall Street expects over the next 4 to 5 years. So pretty remarkable. So we'll see what happens. But yeah, Caleb here says, why not just IPO if you've had a good business for a decade? Right. So here's the way that works. A good business takes a lot of startup money, usually. Now, there are experimental good businesses, and then there are inherently good businesses. An inherently good business does not actually require that much startup capital because you start making money very quickly. I'm not trying to pat myself on the back here, but I just don't think it's challenging what we're going to do. But with my real estate startup, knock on wood over here, with my real estate startup, I expect we could take a small amount of money relative to, the world of venture capital and actually start making money right away or very quickly. And then for, about 10 years or 7 to 10 years, make a lot of money and then IPO. So it'd be a very traditional path. Start with small seed, grow that, make money, prove profitability, and IPO. That's your traditional model. The problem is if you just have like some crazy idea that is either going to go to the moon or just completely collapse, like we're going to make solid state batteries or we're going to put nuclear power plants everywhere in people's neighborhoods. These ideas take hundreds to billions of dollars without any expectation of return until all of a sudden the pieces fall together, and then the returns are insane. And so what people do, or why they SPAC, is they basically try to, I hate saying this phrase, but they kind of cheat the money-raising process, because what they're doing is, rather than going through a traditional fundraise, which could take you like a year to put together, you basically just go to a blank company that is a company that's IPO'd, with a ticker like ALCC or whatever, Alt-C. And that company had basically a zero everything on their balance sheet. It's easy to audit. It's easy for the SEC to say, okay, yeah, go ahead and IPO. They IPO. They don't even ring the bell or anything. They just start trading on the stock exchange for $10, some form of par value. And then what happens is they say, who can we merge with? They come up with some crazy outlandish projections and story and narrative. And then they merge with that company, usually in the span of 3 to 6 months, with very limited SEC review. So really what you're doing is you're skipping a lot of the SEC review. you're skipping a lot of the underwriting that you would get from a traditional IPO, and you're skipping that traditional market testing that people like to see before a company actually goes public. So you're shortcutting all of this to try to make a bag of cash up front. And that's why I'm not the biggest fan of SPACs, because I kind of think they're just cash grabs, especially since the people who put their name on it, they end up taking these insane fees of like $50 to $100 million, 10 to 20% of the money raised. And that's just nuts. $100 million payday for doing a SPAC. I mean, don't get me wrong, it seems like a great business model, but I don't know. I guess we'll see. So, good luck to Oklo, but that's my take, I suppose. So, okay, that covers our Oklo segment. Now we are still 28 minutes away from the CPI report. Kind of excited about that. Let's get a Twitter space person on in here. All right. Let's see here. Let's see. Okay, we're gonna add. Who's this? Magic. See stuff. Analyzer. The future was blockchain. Oh, nice. Okay. Come on in. All right. Let's. I think you should be able to speak now. So give it a shot. We'll see if the folks on YouTube could hear you as well. Okay. While you're doing that, let's get another person in here as well. Okay. Here, I'm just adding 3 people as speakers. So welcome aboard. We'll see if YouTube and Twitch can hear and speakers here. That'd be kind of cool. I saw somebody left a comment and they're like, "Oh, Kevin, you can't stream on Twitch and YouTube at the same time." Yes, you can. You just can't be monetized on Twitch. So I just turned monetization off. Anyway, all right. Can one of you hear me, Joe? It looks like your mic's on.
Can you hear me?
You betcha.
Oh, I can hear you. Yeah. Hi there. Welcome. What's up? What's going to happen with CPI Day? What's on your mind?
Well, I'm a big fan of small caps, Kev. I want to see small caps rebound. What's going on in that world? Do you see this as the market bottom? Finally, the Russell's going to come back, or?
I think that's a really good call. I think over the last few weeks, we've actually seen a lot more potential for that happening. I mean, it seems like every single morning I pop open, Webull, and I'm looking at the pre-market, and I'm like, man, it's all the small caps. They're starting to run again. I think you might be onto something, and I think there could be an opportunity. Like, I was literally thinking about this yesterday. I'm like, it might make sense if we get a dip after CPI. And if let's say the details aren't that bad, but you get a dip after CPI or a dip after the Fed meeting, maybe it makes sense to try to go find some low vol small caps, low historic volatility, buy some long calls, get something getting you out to maybe March of next year. It's a little long, it's a little expensive, maybe go slightly in the money, but now you're maybe 50%-ish leveraged without margin, and place a diversified basket of bets. You just look for the small companies that you like, or even the smaller ones. Who knows? Is that a Matterport? Is it a Robinhood? Is it a SoFi? Whatever it is. It seems to me like as the ocean tides are rising, everything's coming up. So I think it's a good question. Thank you for that.
Yeah, it jumped in my head just mainly because, I'm watching the SPY for the last few years after the recession's finally hitting, capitulation, basically. I'm seeing this SPY, I'm seeing all the big caps, and they look like they're getting close to peak to me. And it's scaring me, but getting exciting, because then I see all the Russell indexes saying that the Russell has not matched the hype of the disruptive sector. You got AI stocks that really are going to change the world in the next 5 years. I'm going, okay, why are these companies not getting bought yet? I'm going, okay, who's not closing their short positions? There's like that dynamic going on of, the big caps just don't want to let the little guys get ahead. But, eventually there's a tipping point, right?
Yeah, I think that's a really good analysis as well. What's remarkable about business in general is that when a business becomes really successful, they don't stay a small cap. They get huge, right? You become a mid cap very, very quickly. So there is that inherent risk that the small caps do to some extent get left behind just by the virtue that maybe they're not as capable of competing. But when we do, on the flip side, look at the Apple and the Microsoft, yeah, I mean, the valuations here are wild. Part of that is likely because I think you have so much money that's moved into the sidelines, whether it's into bonds or just high yield savings accounts or whatever, where people have been almost shell shocked by what happened in 2022. In order to get people to come back into the market, they're like, oh, am I going to go into the SPAC world? Damn, screw that. I'll put my money into Microsoft. Like there's almost fear about getting back into the stock market, which is actually
safe haven,
a
right?
good opportunity to buy. Go ahead.
No, sorry, I just wanted to throw in the word, safe haven. That's what it sounds to me, right? Like Apple, Microsoft, the big caps, the safe haven, right?
Yeah, I exactly that. And that's not uncommon either. That doesn't mean though there's not a good opportunity. I think if you find a small cap you believe in that has good fundamentals and the darn thing's trading low, it's got low volatility, I think there's an opportunity to really go calls on some of these smalls. Do you have any particular smalls you're looking at?
I have incredibly weird tastes and weird approaches to the market. I like you made a mention. God, Matt, this was maybe a year ago longer. You were mentioning that if you want to learn the most about a company, if you're just out and about in your daily life, paying attention to which pubcos are actually behind the products that you're shopping for, you'll spot some irregularities in stocks versus what the company's actually doing. Like I would probably get flack from a lot of people for this, but I really like Tough Built. I like TBLT a lot because one of the things I notice is they're one of the products when you go into these hardware stores and they have no stock because people are buying up all their product. But yet you're seeing the share price in like a company like that just completely get pummeled. And I'm looking going, okay, wait a minute. This is an acquisition kind of company. I'm like, Tough Built, everyone buys their product because when people don't have a lot of money, especially tradesmen, anyone in construction, plumbers, electricians, they have great products to keep a little guy who can't afford a whole lot of money to buy the big name brand DeWalt, kind of stuff. They can afford it. I'm thinking it's just one of those companies that I think is a little too beaten down.
Yeah, I hear you. So Tough Built, these are you're right. I mean, I'm just looking online quickly. Here, I'll put some up on screen. I'm looking at worker bags. I'm looking at cutting tools, sawhorses, boxes, tape measures. We've got hammers here, laser levels. It looks like you've got a whole lot of these carried at Lowe's. So a pretty typical workman product here. What I'd be curious about is looking, because I'm looking at the stock chart here, and you're right. It's like hardcore penny stock. And I was just talking about Oklo, the SPAC, and what's crazy is back in the day, if you had a SPAC get on the front page of the Wall Street Journal, you'd end up getting the SPAC spiking $4 or $5. The darn thing went up like 30 or 40 cents. Nominal. So there is definitely a risk aversion right now, but this is wild. I mean, here's a company with a market cap of $7.6 million. I'm not sure if are these shares actually representing 100% of the company, because that does feel like a very, very small market cap for a company that does have such a brand. I did pull up their investor relations page here. Here could be potentially some of the issue. So this is just my second looking at this, but first quarter here, it looks like you had a net loss of $8.2 million. However, a lot of those came from some form of warrant and option liabilities. So something's going on here in terms of with how the company is or went public. You actually do have cash flow to some extent that they have $782 million of cash here, but then they spent that and their free cash flow is negative. So you're burning cash over here that's going to about $470 million. $470,000. Boy, I'm not used to these smaller companies. $470,000 net cash provided of about $782,000. Usually all these numbers are in thousands. These numbers are just straight up the numbers. What do we have in income here? So in revenues, you've got about $20.2 million in revs, gross profit of 3.5. So what is that, about 15-ish%? But then I don't know what's happening here. This is scary. Look at this. SG&A, $15 million. So a company with gross profit of $3 million is spending $15 million on their employees. So I don't know. I mean, obviously that's not sustainable. And then another $3 million on research. They're spending as much money on research as they are actually making money. So I don't know what happened here, if it's always been like this, but obviously these numbers, as much as the brand could be great, don't look excellent. But hey, thank you for bringing that one up. I'm gonna mute Twitter Spaces here for a second because we are getting close to CPI, and we'll come back to Twitter Spaces. So let's do a quick peek of the premium. By the way, again, thank you for bringing that one up. So jumping into what we've got pre-market here, there is some pre-market excitement. We're up 19 bips on Dow, S&P 29.35 on the NASDAQ. 10-year bond back down under 3.95. U.S. mortgage rates still at the or should I say, highest levels that we have seen since November. And now we are prepping, obviously, for expectations for CPI. We did have Nick T tweet out a nice summary, actually, of CPI expectations. Usually you get some good scenario analysis as well from JP Morgan and from some of these other banks. So I'm very curious, obviously, to see in 15 minutes how CPI ends up playing out. We may as well go through some of the projections here. So looking at Nick T, and then we get, I believe I have JP Morgan's piece as well here. So Nick T. Oh yeah, here we go. June CPI preview. Okay, fantastic. All right, so we're going to go pull up the preview. Let's write this all down. All right, CPI preview. Okay, so we are now 17 minutes away from this. Nick T gives us some expectations for CPI. So Goldman, we're lowering our core 2023 PCE forecast to 3.7 from, to 3.5 from 3.7. And part of this expected drop comes from autos, shelters, and residual seasonality. So you've got some lowering of longer end of year expectations here. As far as CPI expectations coming up, Goldman's looking at 0.23% month over month in core, lowering the year rate to under 5% to 4.93. UBS is looking for a core of actually 0.12. Personally, I'm looking for a core of 0.2. That's my big number. That's why I'm looking. I really want that 0.2. It'd just be so good. Citi's got a core expectation of 0.26, Morgan Stanley 0.27, BofA 0.29, and Barclays at 0.3 for core expectations. When we look at JP Morgan's CPI, let's go ahead and read their CPI piece here and get into this. Yeah, remember, we are now not only pitching a delicious coupon code for the programs on Building Your Wealth, link down below, and course members, getting special benefits out there to course members. By the way, if you're a course member, you could shadow me for a massively reduced price for a very short period of time. The last time we did this, we sold out like 3 months of shadowing in 3 days. So go to meetkevin.com, and there's a section on the front page talking about that, so you can see and learn more about that. But anyway, core CPI inflation to prove sticky at 3%. Core CPI inflation has persisted, running at about 5% through May, with core goods inflation re-accelerating. The surge reflects used car prices, which, like rents, could soften during Q3, delivering 3% core inflation. Okay, inflation has come down, but the pace of slowing has disappointed expectations, says JP Morgan. Coming into 2023, we project the run rate of core inflation would decline to an under 3% pace. We're projected this coming into 2023, driven primarily by continued softening. In actuality, core inflation has been stickier, with the 3-month annualized rate still at 5%. this is probably one of the reasons you've got a Fed that's a little bit more aggressive here at trying to drive core down. One thing that's interesting, though, is we just had what's it called? The Wall Street Journal put out a phenomenal piece discussing that if we measured CPI the way Europe measures CPI with a harmonized CPI, we would actually be under 3% with core inflation right now. And we'd probably be looking at inflation as having proved to be transitory. So part of this has to do with the owner's equivalent rent problem, that we measure rents in a very bizarre manner. But hey, that's that's the way it works. So we got what we got. Now there are arguments for why the way we measure owner's equivalent rents exist, but it still frustrates a lot of individuals. So let's keep going here with JPM. So let's see here. Okay, the inflation has remained more persistent than expected, consequence of a more resilient economy. I mean, obviously that makes sense. Then you've got, against the backdrop of high unit demand, many firms retain pricing power as demand remains fairly robust, supported by a more significant fall in headline inflation as energy shocks wear away. Yep, this is true. From a bottom-up perspective, our forecast is informed by three key dynamics. First, the well-understood gradual decline in rental inflation will continue to exert downward pressure on core CPI through at least the end of the year. This is good because it really does give us a tailwind. Very good. Let me paste out there really quick. There we go. Okay. I by the way, I just edited into the first comment in the live stream and at the bottom of the YouTube. You might have to refresh for it. But we have a newsletter now where we send daily emails. It's totally free. So if you want some daily free insights from me via newsletter, check out that link. Again, it's in the description of the YouTube video. You might have to refresh to see it. And I just reply commented on Twitter, so you could go to reply comments and see it there. Anyway, second, some idiosyncratic sources of elevated inflation, mostly in the goods space, will break lower in the coming months. Okay, I'd like to see specifically which they're referring to, but that's good. And then in core services, you're likely to see a persistently high, including auto insurance level, as well as health insurance. Bottom line is, don't over-extrapolate from the near-term slowing in core. The pace of easing looks to remain uncomfortably gradual. I'm not convinced, though, that this gradualness is as bad as some of the bears on Wall Street are really calling for. I actually think that there's a lot of power to saying, look, we've got a strong economy. Let's just follow the path that the Fed has previously paved, which is opportunistic disinflation, and essentially don't drive the economy into recession, and be patient about inflation coming down as long as inflation expectations are stable, which obviously last night we posted a video breaking down inflation expectations and how important the 5-year break-even rate is to the Fed's activity. Now, if you haven't seen that video, I'd encourage watching it. But okay, good. So JPM does still expect a recession towards the end of the year, which is not ideal. But then again, if we don't get a recession, maybe it is perfect, because what did it do? Gave you more of a buying opportunity if you're bullish. So that's fantastic. So again, we are now just 10 minutes away from our CPI read. Excited to see this. JP Morgan's expecting a 3.2% headline CPI read. And they are also expecting 0.3% for the month-over-month. These are the Wall Street expectations. 0.3% month-over-month, core 5%, and then core month-over-month 0.3%. So both of the month-over-months expected to come in at 0.3. So we'll see what we get here. Really hoping for a 0.2 somewhere. We'll see. Okay, so sometimes JP Morgan also puts together a beautiful piece on, hey, what they think is going to happen if CPI comes in at high or low, what they think is going to happen in the market. They're actually usually not too far off. However, I can't seem to find that piece right now, so I'll keep hunting for it over the next few minutes, although it might not be so important given that we're basically about there. Let's listen to CNBC for a moment. If you're on Twitter, I hope you can hear it. Anyway, here we go.
Democrats on here as well.
Well, let me know if it's too low.
And I don't know, when you hear about banning something, that raises, no matter who you are, that raises sort of, in the private sector, it's like, do we really want to do that? So this would maybe harness things with TikTok, but not ban it outright.
Correct. So what we want to do is make sure that the data of users of TikTok is protected from surveillance by the Chinese Communist Party. And the way we're doing that is to provide for a registration. So there is a wall between people's private data and the opportunity to use it as a mechanism of surveillance.
Do you, can you give me a timeline on a spot Bitcoin ETF? When do you think that's going to happen in your, that might change things. That might give.
I actually agree with a commenter here that I don't think this person has any freaking idea what they're talking about, but let's listen for a moment. Congress.
That might happen, right? If there were a spot ETF, will that be signed off on anytime soon? I mean, you've got big names, BlackRock, involved there.
Exactly. So you have these companies that a couple years ago were complaining about how Bitcoin and digital assets are used for illicit finance and they're fraudulent. And now, of course, they want to incorporate them into their business models. So for one thing, I think that's recognition that these assets can be a store of value and eventually a means of exchange, and they want to add them to their offerings. I hope that it's going to come sooner rather than later. The futures market, the spot market, and the CFTC's involvement in integrating Bitcoin specifically, but other digital assets as well, should make for these companies to be able to have these offerings in a way that has adequate consumer protection, protects against illicit finance, and shows people that these assets are here to stay.
Yeah, I'm going to just jump in there and say I really wish Congress would get off their butts and just regulate. Because if they actually came out and said, hey, look, we are going to bestow the power of regulating crypto on, the CFTC, and we want crypto to exist or whatever. You actually had regulation and rules that these companies could follow, whether it's Coinbase or Binance or whomever. Then you could actually regulate. But this is nonsense right now is that Congress has not acted. Congress has done nothing for crypto. And that's leaving the SEC and the Commodity Future Trading Commission essentially fighting each other via lawsuits, which is a horrible way to create law because you're basically relying on judges to make a determination themselves, and who's the judge to essentially come up with their own determination on whether crypto or one crypto is a security or not. It blows my mind. So I suppose we'll see, but anyway, we are as much as we can be hopeful about crypto, we are now about 5.5 minutes away from CPI. Nick T just 7 seconds ago just tweeted why the Fed won't overreact to one appreciably better CPI report. Inflation has slowed before, only to rebound later. July, August 2021 appeared to validate that. And then you have only to come back later, hotter. And then the auto/shelter disinflation has been anticipated for months. I find it very interesting that you get Nick T, who's basically your Fed mouthpiece of Fed leaks, coming out suggesting that hey, if this report happens to be better than expected, no hints here, not going to be 0.2% or anything, then don't worry, the Fed's still going to tighten. Okay. I really believe this. I really believe that the difference of another 25 or 50 BP is not present. Like they're like negligible. I got some comments yesterday, and I still look at what you say. I appreciate y'all. But I got some comments yesterday because I said that yesterday, and some people were like, Kevin, the Fed's already gone too far. How could you say nobody cares if we get another 25 or 50 BP? And the reason I believe that is because of the delta change. That's redundant. The change, right? So the change from March of 2022 to now has been 500 basis points. Now we're complaining about an extra 5 or 10%, 25 or 50 bips. Come on, man. It's just not going to make a difference. Like if a company's going to go bankrupt at 5%, they're going to go bankrupt at, if they're going to go bankrupt at 5.5%, they're going to go bankrupt at 5%. Same thing at 5.25. If that's too much for them to carry, they're going to go bankrupt anyway. The marginal difference of an extra 25 or 50, I really do not believe matters. Now, I've been a big believer in this Nike swoosh recovery. I've been talking about this Nike swoosh recovery for quite a while now. Big believer in it. And I didn't actually think it would be as rapid as it has been. But I think as we continue to see inflation slowly trend down, even if it takes more time, people won't so much care that rates are higher for longer, as long as we're not going into a deep, dark rug pull recession where inflation expectations unanchor and you really end up getting a poop show. That's what you don't want. You don't want a poop show. Nobody wants a poop show. It's really crappy. But what's not really crappy is that we have a free newsletter now. And it's an email newsletter. I honestly, for years, I've been avoiding having a newsletter. But the amount of positive feedback that I get on a daily basis, and I read your replies, people are sending emails on a daily basis going, this is amazing, great way to start my day, or whenever the email goes out. People love these. Really, it's motivation, it's insight, it's great. It's actually a fantastic newsletter. So what you should do to get it is refresh the YouTube video description where I'm streaming now, or just go to my Twitter replies segment. And you'll see I posted a link to newsletter. So sign up for that if you'd like. It's totally for free. And then, of course, if you want to check out the courses on building your wealth, we have a coupon expiring in 2 weeks. It'll be a pretty big coupon expiration as we get into the second half of the year. So we're very excited about that. Okay, we are now 1 minute and 30 seconds away from CPI. So let's see here. Let's see here. Okay. 0108. All right. CPI release. Oh, this always makes me nervous and excited. It's like, this is probably the biggest report. It's exciting though, but it realistically is the biggest report that we have this month. Like whatever the Fed does or says is based on this usually. It's not even PCE, and we cover PCE, we cover jobs, we cover all of it. But this is exciting. Oh, look at that. We got some shout outs here in the chat. The Alchemist says the newsletter is amazing. Love the newsletter, says Chevy Jeff. Thank you. Thank you so much. So again, that link is down below in the YouTube description or down below in the replies section of my Twitter. And the courses on building your wealth, big coupon. Expiration is 2 weeks away. Email us at staff@meetkevin.com if you have bundle up questions. Keep in mind, course members can now shadow for a pretty substantial discount. And that's a course member only benefit. You can see that at meetkevin.com. Okay, here we go. Wall Street expectations for inflation, 0.3. Wall Street expectations, that's for month over month. Core month over month, 0.3. CPI year over year, 3.1. CPI core year over year, 5%. Kevin's expectation is looking for a 0.3% month over month and a 0.2 on the core. Here we go. We got nothing yet. Come on. It's always so intense, that minute. Sometimes it takes like 15 seconds to actually show up. Here we go. Core year over year comes in low, 4.8. I don't know why the other numbers haven't come in yet. 4.8 is the core year over 0.2. Let's go. Wait. No, that's on the headline. Oh, crap. Okay, wait. CPI month over month, 0.2. Wait, yeah, there it is, 0.2. It's also 0.2. Let's go. Okay, great. Oh, wow, this is crazy. CPI year over year comes in at 0.3. All of it comes in low. Nick T once again leaks it before. Once again, Nick T gets it right. Happens to leak the CPI data before because he gets it, probably just like J-Pow gets it. And they're like, make sure to temper the markets. Don't let markets rally. Nope. We going to the moon, baby. CPI month over month comes in at 0.2. CPI core comes in at 0.2. CPI year over year, excuse me, comes in at 3.0, and CPI core year over year coming in at 4.8. Every single one of those numbers coming in low. This is absolutely fantastic. Let's go ahead and get the actual report. While I do that, let's listen here for just a moment.
Well, and up 0.2 on the core is the lowest level going all the way back to February of 21 when it was only up 0.1. And if we look at year over year, up 3%. 4% in the rear view mirror. Well, 4% in the rear view mirror was the lowest level since March of 21. So when you see 3%, you have to go all the way back to March of 21 again, because that's where the comp drops from down to 2.6 is what we're comping to. And in the rear view mirror, 4%. And here's another one. If you look at X food and energy, last month was up 5.3. That was the lowest level since Nova of 2021. We breached 5% to 4.8.
This is great. Let's get into the actual report. This is phenomenal. Congratulations. This is great news, everyone. Knock on wood, this continues, but it's great news. Okay, let's get into the actual report. Here we go. Index for shelter was the largest contributor to the increases. Okay, listen, you probably haven't heard this yet. I'm going to give you a bottom line. The Wall Street Journal ran a fantastic piece. Bottom line, they said, if we didn't use the dumb, stupid owner's equivalent rents for our shelter inflation, our core inflation would be somewhere around 30% lower than our core inflation is right now. In other words, we're stupid for using the data the way we do versus the way Europe does. If we measured our inflation the way Europe does, inflation would be over already. This is phenomenal. But anyway, this totally aligns with the Nike swoosh recovery here. Shelter inflation was the largest contributor to all items increase, accounting for over 70% of the increase. 70% of this trash CPI is just from housing. And we know that's already rolled over for rents. With the index for motor vehicle insurance, that was a red flag coming up. Dude, Nick T with the leaks, man. JP Morgan called that too, though, with motor vehicle insurance. The food index also increased 0.1%. That's nominal. The index for food at home was unchanged. That's flat. Food away from home rose 0.4%. Not a surprise that you're getting that in the summer. The energy index actually rose 0.6% as oil has actually been trending up. And wow, you're still getting this total miss on CPI. This is fantastic. Let's get into some of the actual categories here. I want to get the individual categories here in full. So, okay, let's get this. Okay, here we go. We're going to get the full tables, and we're going to go through specifically which categories are burning here. So pulling this up right now. 1 second while that PDF loads. Remember, 2 weeks away from coupon expiration, and get that newsletter that we're doing now totally for free. Link down below. And course member shadowing discounts available at meetkevin.com now. If you're a course member, if you're a multi-course owner, the discount actually goes up even more. So what do we have here? This is the CPI breakdown. I like to go to the back. Okay, here we go. Motor vehicle insurance. The right side is the month over month number we're looking for, May to June, seasonally adjusted. Oh, wow. Look at that plummet in airline fares. This is phenomenal. A crash in airline fares. Let's go. I hate airlines. 8.1%. Let's go. That is an 8.1% to the downside. Motor vehicle insurance still hot. 1.7%. An annualized figure times 12 is 20.4% annual inflation here at motor vehicle insurance. That is an ouchie wouchie. Motor vehicle maintenance and repair at 1.3%. This is a chicken or egg problem, really. Well, it should be motor vehicle repairs costing more lead to more expensive insurance. Wow, look at that. Transportation services, thank goodness, back to 0.1%. This was a red flag in the last CPI report. When we got 0.8, I was a little nervous. I'm like, wait, wow. But what happened here is airlines sandbagged the motor vehicle insurance increase, even though airlines have a much lower weight than motor vehicle insurance. That's great. Hospital services at 0.4, still a little hot. Physician services, 0.7, still a little hot. Owner's equivalent rent, still coming in at 0.4. But look at what's happening. It's coming down, folks. It's coming down. 0.5, 0.5 to 0.4. Previously, this was 0.7, 0.7. So we're finally coming down in some of these numbers. Rent of primary residence still sitting at 0.5, also high. Therefore, the shelter index. Look at that weight on shelter, folks. Shelter, 34% weight here. This is crazy. You've got apparel at 0.3%. Actually surprised that's at 3.6% annualized. Used cars coming down. Yes, look at that. This is the leading wholesale indicators were that used car prices were coming in to plummet, and they finally are showing up in CPI. Let's go. This is great. Oil just broke $80, by the way, for the first time in many months. But it's probably because this is fantastic for the stock market. I mean, this should be fantastic. I mean, I don't know. Let's take a look in just a moment. Electricity up 0.9%, energy up 0.6%. Didn't seem to matter, though, as we really got an explosion here in terms of good numbers. I'm really happy about this. This is fantastic. I'm telling you, Nick knew it. JPOW can get these reports ahead of time. That shouldn't come as much of a surprise to you. But I wouldn't be surprised if you got a little text-a-doodle from JPOW going, hey man, don't let the market rally if it's just one good report. Because what a weird report, what a weird tweet. Nick T's like, hey, if we happen to get a good CPI report, remember, one CPI report doesn't make a trend. Come on, man. There is no better indicator than that. But as you can see here, this is phenomenal. NASDAQ in the pre-market is up 1%. Tesla up 3% in the pre-market. Enphase up 1.5%. NVIDIA up 1.44%. Intel's up 1%. Ubiquity up almost 2%. This is an undervalued play. If you're looking for a value play, do some fundamental analysis on Ubiquity. A lot of insider control, but that's because this company prints money and it's selling for less than a 1 peg. Trade Desk has been on an absolute tear, $82 over here. Bitcoin looks like it's trying to move on this as well, almost at 31K. Embraer is up another 2%. Apple's even up at 0.64. Snowflake is up a little. Neo 2.5. Let's see if we've got any. Dow Jones is almost up 1%. The Dow's like never up almost 1%. This is remarkable. You've got Domino's Pizza up 12%. SunPower up 9% here. Open Door is almost at $5. I called this with course members. I told them, I go, this is a $1.30 stock. This thing's going to skyrocket, even though I hate the company. I thought it was going to go to $2 or $3. I didn't think it would go all the way to $5. It's almost at $5. I'm like blown away. Like, I wish I put a lot more money in that. Oh, well, that's the thing about hindsight. But the leading indicators, the leading fundamental analysis was on point. Anyway, Zoom is actually down 4.7% here in pre-market. Redfin down 2.4%. But these companies were also up yesterday. Actually, was it? Yeah, both of them were. Redfin was up 23% just yesterday. I mean, here's your small cap revival coming back. Remember, Redfin bottomed at like $10 actually much lower this cycle, but during COVID. Now you're sitting back at $15 and then it just ran. Volumes for real estate agents still very low though, so I'm not particularly enthused about earnings for some of the real estate companies just because volumes are expected to be so low. But anyway, phenomenal CPI report. Let's get into the detail. So this goes even another layer deep in terms of what we could glean from this report. Tax preparation services, 1.8%. It's a little expensive. Financial services are up there, 1.6%. This right column, by the way, is our May to June. And then the prior 3 columns are all just the prior seasonally adjusted numbers here. So tax prep services coming in a little pricey here. You've got apparel and dry cleaning at 1.3. That's high. However, if you bundle it all together, once you include laundry and the other miscellaneous personal services, only at 0.1. You've got personal services at 0.4, driven by haircuts here. Actually, that's the only one. Haircuts and personal care, 0.4. Little high. Telephone services down 1.2%. Residential phone services, who still uses that? 0.2%. Postage, we did get postage stamps going up again. I grew up as I was born when postage was like 29 cents, and stamps were like 30 something cents throughout my childhood. Now I think it's like 65 cents or something. It's crazy. Anywho, education is actually down 0.3%. Admissions to sporting events up 5.5%. Yikes. That's a big number over here. CBOE volatility index hits a 1-week low down to 1406. So much for that cathartic blowout on the VIX that everybody was waiting for to step into the market. Just hasn't happened yet. Then you've got public transportation. Wow, 6.8% decline right there with that 8.1% airfare decline. Fantastic. Okay, motor vehicle repair. Unfortunately, that's where we saw still some heat. But it's not in body work. It appears to be in maintenance and servicing as well as repair, but not body work. That's only at 0.2%. Leased cars and trucks still up, but car and truck rentals down 1.4%. Phenomenal. Easier to finally 3 months in a row here of declines in car rentals. Health insurance decline. 3 months in a row of declines here. Hospital services 0.4%. There's that darn household owner's equivalent rent, domestic services. That's hot at 1.4% here, but also very, very small weight on domestic services. Rent of primary, again, this is where you're getting some of the ridiculous numbers. Wow, look at that. We actually got a negative in lodging away from home. Holy smokes. Lodging away from home, specifically hotels and motels, down 2.3%. Now, I thought we were going to get a blowout here because of summer travel, but what would offset it would be seasonal adjustments. These are the seasonally adjusted numbers. Keep that in mind. You've got other goods, 1.1%. I mean, this is nothing, but you do want to be careful that you potentially get a reanimation of goods inflation, right? I don't really think so, but a lot of people worry about that. Wine at home, down 0.6%. Lauren will be happy. Alcoholic beverages away from home, 0.5% to the upside. Okay, what else do we have here? Alcoholic beverages at home, 0.2 to the downside. Smartphones still getting sandbagged, 1.5% to the downside. Education's down, negative 0.1. These are just great numbers here. This is a phenomenal CPI report. Remember like a year ago, and I'm like, I can't wait in a year from now. Hopefully we're looking at a CPI report that's mostly negative, like negative. It's here. It's kind of crazy. Newspapers up 0.3%. Who reads newspapers? Well, I do. Anyway, what else do we have here? Sports equipment down 0.3%. Sporting goods 0.3%. Oh, wow. Really? Look at this segment that's starting to roll over. I've been waiting for this segment to roll over. Absolutely waiting for it. Because you look at like the Petco and some of these other pet suppliers, they've actually still been seeing strengthening pet inflation, and it's been a concern. But take a look at this. Negative 0.5 for pet and pet products. Woof. Finally. New cars, new vehicles flat on new vehicles. New cars, negative 0.2%. New trucks flat. Used cars, negative 0.5. Fantastic. Infant and toddler apparel, 0.7. Oh, of course. As soon as I'm expecting twins, infant and toddler apparel goes up. Great. Girls apparel, though, is down. And these are twin girls, so maybe they'll grow into that downside of lower pricing. But infants, more expensive. Great. Okay, men's apparel, 0.4% over here. What else here? Women's outerwear and dresses, both negative. Housekeeping supplies, 0.1. Tools and hardware, 0. Dishes, flatware, 1.5. Appliances. Yeah, let's look at those durables here. Appliances, negative again, negative 0.1%. Furniture and bedding, 0.1%. Nothing over here. Household furnishings and supply, negative 0.3%. Price decreases over here. And of course, you had some of that energy push up. Eggs, folks, look at the eggs deflation. Another 7.3% down. Milk is down. Fresh fruits up a little bit, but those are very volatile. Okay. Wow. This is an excellent CPI report. Looking for some additional CPI or Wall Street reactions here. Let's go to the Wall Street reactions quickly. Reminder, courses on building your wealth. We got 2 weeks for the next massive price increase. This is going to be a big price increase, adding a lot of value to the courses regularly. And make sure to check out that you can now bundle up the shadow program. If you're a course member, large discount. You can see that at meetkevin.com. So it really incentivizes a reward for existing course members and potentially new course members. And then, of course, check out the free newsletter where you can get daily insights from me by either clicking the description on YouTube right now or looking at my reply tweet on Twitter. Just go to my profile, Real Meet Kevin on Twitter, hit replies, and it's the first one there. Okay, let's see here. Cycle high yields are likely to hold. Okay, the legitimate case for the Atlanta Fed boss. Okay, wait, hold on. As expected, today's CPI print added fuel to a recent bond rally by taking away the tail risks for rate hikes. With the month-over-month headline and core numbers both coming in at 0.2, there's a legitimate case for the Atlanta Fed's holding for a rate pause, basically, or holding longer. Wow. Rates tumble as traders abandon a second rate hike. Fantastic. Okay, great. Dollar tumbles. CPI falls short of forecasts. Oh, this is great. I want to get some specific CPI insights. Let me also look at the 10-year, and then we're going to look at the 5-year break even. Pre-market. Oh, yeah. I mean, all the indices are up. I mean, Dow's up 0.6, S&P's up 0.8, NASDAQ's up 1. You've got the 10-year Treasury down 6.3 bips. Let's look at the actual CPI report for June. Analysts here, or analyst results here. Let's see here. Looking beyond the July meeting for a moment, these numbers will make the speech at Jackson Hole a lot more crucial for setting the future of policy. Oh, talking about Jackson Hole again. Great. I didn't like Jackson Hole last year. That led to a hard one. Anyway, Bill Dudley, former president of the New York Fed, said this opens up the question of whether July will be the last rate hike. Ooh. Fed will take some comfort in the fact that core service CPI ex housing has slowed below 4%. Oh, this is such a good chart. I want to show this chart to y'all. Stand by for a moment. I want you to see this rollover. Remember, this is the opposite of what's happened at the United Kingdom, where you had this resurgence of inflation in the UK. We do not want to see that here. So I'm going to pull this chart up and describe it for those just listening. But basically, here's a chart of core services ex shelter inflation. So stripping out shelter and just looking at what those core inflation numbers are doing. What do we got here? We've got core inflation coming down from a peak ex housing of around 6.8% all the way down to just under 4%. This is a very, very good chart. We're going to look at those 5-year break-even expectations in just a moment. You are right to ask about it. I want to see it too. I really want to see it go to like it. This, in my opinion, well, let's just look at it now. In my opinion, it should probably drop it to 2.1, if not even lower. So yesterday we were at 2.2. I usually have a little bit of a lag in getting the 5-year break-even inflation, but it should have updated now. So I'm going to guess if I could get a 2.09, I'm going to get very excited. Like under 2.1 would be very exciting. So let's see what we get. 2.15. So it did drop substantially. I'll show you, I'll zoom into that chart at that bottom right corner here. It is falling still. So let's see here. Here it is on screen. You can see that plummet. Still on the lower trend line. We were talking about this yesterday. You're still on that lower trend line though. So we haven't broken that. So if I draw a trend, you can see you're still in that rising path. If we break to 2.13, 12, we're going to break that trend line. And if we hold under it, hopefully those 5-year break evens really start going down. And that's going to mean the Fed's going to start pricing in the pause officially and cuts. Let's look at the Fed term rate expectation. Yesterday, we were at 5.36, which was fully pricing in the next rate hike. I would argue that this should be 5.34, 5.322. A nice drop off. Okay, very good. Very good. And if I go to the rate monitor for the FOMC rate, right now we are looking at exactly 2 weeks away from the next Fed decision. That means we're also 2 weeks away from the expiration of that coupon code. Email us at staff@meetkevin.com if you have questions. Still pricing in a 91.8% probability of one more hike. However, the odds of going to of staying stable, actually those have remained stable so far, 73.4%, although a little bit more on the pause side. Okay, looking at a bit more, a lot of talk about higher food prices affecting consumer psychology, but inflation in food is becoming less of a story. Meat, poultry, fish, eggs dropped 0.4% in June. Regardless of where you sit on the Fed debate, inflation decelerated in June to the slowest pace in more than 2 years. Question now, is this a genuine turning point? Nah, it's a Nike swoosh, baby. Ooh, that was a good one. Got him. Everybody's like, it's going to be this rapid U-turn. It's like, nah, man. It's going to be slow. It's going to take time for people to realize inflation truly was transitory. Ooh, I'm still going to piss people off for saying that. Whatever. I say stuff to piss people off every day, and I sincerely do apologize. But I stopped caring. So $1.101.15, nice little drop there from 101.1 or 101.4. Housing costs accounting for 70% of this CPI increase, absolutely insane. So look, I mean, this is phenomenal. This is absolutely phenomenal. This is great. By the way, if you ever want to intern for me, send an email to jobs@meetkevin.com with a 1-minute video, and you can intern for us potentially. We've got a really amazing group right now. And we're very excited about the many differences or many different businesses that we are expanding. We have a lot of fun every single day working on all of them. So if you're interested, you have to work locally. No remote, sadly. All right. So this is great. It's a great CPI report. Thanks for watching the CPI segment. Let's move on to other news. All right. Actually, let's go. We're going to listen to what Doomberger has to say about this one, but this is a sexy CPI report. I like this one a lot. All right, let's listen to Doomberger. You ready for this? Hopefully y'all can hear this on the Twitter world. It took me weeks to set this crap up.
19 on a core basis, just 3 stronger than expected monthly CPI readings. That has been the fewest since November 2020. There is a sense that Wall Street doesn't have as much faith in the disinflation as is actually coming through in the numbers.
This is really well timed that you bring this up, because Dr. Dudley alluded to that when he did his Newtonian calculus in English, where we talk about the first derivative, the second derivative. You'd make jokes particularly if you had a hangover from course 3-2 light, you'd make a joke about the third derivative or the fourth derivative. But all of this anecdotal evidence leads to some form of vectors which say the agony of this inflation is over. Then the debate begins.
From an investment perspective, Megan, is it time to get out of cash? Maybe not go into riskier assets, but lock in yields at a higher
That's what
level
David Kelly
if
said.
we are seeing inflation come in?
And we actually started to do that recently as well. We moved
sure you
our
did.
duration of our fixed income investments out a little bit, not significantly long at this point, because I still do think there is that uncertainty around the Fed. Yes, it looks like they may be able to be done in July, but when it comes to rate cuts, when are they really coming in? And we don't think that's the story until 2024. So it's not a rush to run into the long-term yields at this point, but we do think you should move out some of those shorter durations into more of an intermediate duration.
Megan, thank you so much. Megan Hardiman with Verdant's Capital Advisors. Today, I'm going to call it a sustained reaction here. Yeah, there's a little bit of a pullback, and we'll show the charts on TV and discuss them on radio. But the bottom line is clearly off of the enthusiasms of Tuesday afternoon into a Wednesday where I would suggest the disinflationary zeitgeist got it right, Lisa.
Absolutely.
You've got a tangible move here. I'm looking at the levels. I got 4,500 on SPX futures, 34.6 on the Dow. That's 34,600, Lisa, on the Dow. And the NASDAQ 100 to be rebalanced here, up 0.9%. Rounded up 15,400 on the NASDAQ. I'm in triple leveraged all cash. Maybe an odd lot of Apple.
Markets are partying right now. They're excited about disinflation, and the data certainly suggests, any way you slice it, it is inflation going lower. Jason Furman putting out formally of.
I just want to say it's not uncommon for all these hedgies and suits to be like, yeah, we've actually slowly been going long. It's like, no, you idiots. You should have been going long a lot earlier. Now, I know there's a risk to having gone long too early. But this whole, no, Paul Volcker is coming. It's over. Paul Volcker is not coming. Oh, but Kevin, there's going to be a recession. Okay. As long as it's not Paul Volcker, bring it on. We'll buy through it. Companies will look through it, and it probably won't be that bad, whatever it is. I don't know. Maybe that's perma bullish. But you know what? I'm still going to look at the data every single day, and if the data changes, and look, the facts change. I'm going to change my mind, and I'll always let you know about it. I always look back at the history of the channel, and I've always been very transparent with any time I've changed my mind. And even though it's been very unpopular, and sometimes it's gotten hate for changing my mind, it was the right thing to do, and I would always do that. So let's listen to CNBC for a moment.
Yeah, so this one is really ugly. It's 3M. You guys have talked about the industrials and how they've actually.
Is that like a recommendation?
Not done that well. It's down 15% on the year, and it trades at 12 times earnings. Joe, there are.
Because it sucks and there's no earnings growth. 12 times earnings. What is it, a 3 peg? I'll look it up.
And I'm sure that investors on the buy side certainly don't own it as well. But look, they were making progress on the water contamination settlements. There's more that they have to do, but that was good news. It was less than expected in terms of the dollar amount, and it was more comprehensive. We still have to get through the earplugs issue too and settlements there. However, I think that once you start doing settlements, history suggests that the stock starts to rebound. If you look at Bayer and Monsanto, that's exactly what happened. And so they also have a restructuring, and then they have a spin of their healthcare business later on this year or maybe early next year. So I actually think that that's positive, and I think, again, kind of off the radar screen.
You have a couple more?
So it's actually trading for a 1.5 peg. So she's not wrong about the valuation not being horrible for 3M. It's I ran it at an 11.9 PE ratio.
15%, total revenues of 10%. And I like their mix. Their mix is 80% of their revenues are fee-based and 20% is net interest income. I don't really want to have exposure that much to net interest income because we know it's going to be weak this quarter, given where the yield curve is at. So I like the mix. I like their size and scale, especially with the affluent consumer and small, medium-sized businesses, and the return to travel and the return to business travel. So I like this.
Amex, I have to say, I've always kind of had a little bit of a soft spot for. I kind of like that one. Okay, I do want to just mention, if anybody on Twitter, Twitter Spaces wants to chat, send in a request. I want to go back and give Twitter Spaces a shot again. We are now streaming on Twitch, YouTube, Twitter, and Twitter Spaces. I did not know that you could literally be live on Twitter video and live on Twitter Spaces at the same exact time, but I figured out how to do it. I'm very excited about that. So feel free to request if you want to speak, and we'll jump on over to that in just a moment. We have, looks like Bob Iger, Disney CEO, coming on CNBC tomorrow at 8 a.m. That's 5 a.m. Let's watch that tomorrow if we remember. Maybe somebody can remind me. But I'd like to, like Disney, boy, it's supposed to be a stock that you love, but I've tweeted the other day and I got like 5,000 or 6,000 likes. The tweet basically went viral. I tweeted the other day, if you invested in Disney 8 years ago today, $100, you'd have $76 left, which is bad. It's like a 24% decline. It's insanity. All right, let's listen to Jimbo here for a moment.
Tiger tomorrow at 8 a.m. Eastern time.
Yeah.
Meantime, the bulls get their wish as June CPI comes in cool. Lowest monthly core in more than 2 years. Yields are dropping 2-year near 4.75 as a second rate hike this year is now in question. Our roadmap begins with that print. Inflation falling to its lowest annual rate in more than 2 years as well. Plus, game on for Microsoft after a judge rules the company can close its deal to buy Activision. And Domino's shares are surging, leading the S&P in the pre-market, announcing this new partnership delivery with Uber. Let's begin, though, with market reaction to CPI. As we said, coming in lighter than expected, Jim. Airfares down 8, used cars down 0.5.
Well, there's a lot of oddities. I mean, there's a couple of real wins that people aren't thinking about. You've got, you definitely have the used cars, very good, but shelter's down a little bit. And what's interesting is what's up is almost, I don't want to say it's meaningless, but the bakery products, I mean, you can easily trade down on that, right? Fresh whole chicken. So, I mean, switch over to beef.
Eggs down 7.
Yeah, I mean, sugar and sweets, well, good. We should have less of those anyway. The ones that are up, I am telling you, are going our way too. Because there are things that, frankly, are not, if you really got to go granular on this, Pal's winning. Because the things that are up are not nearly as important as the things that are down.
Jimbo's right here. That's actually a good observation that, what's going up, especially that housing segment, isn't really what the Fed is concerned about. They're really concerned about wages leading prices to spiral. And we did get a little bit of a warmer wage print on that last BLS wage report. So it's fantastic that we're not seeing that really translate to consumer prices yet. Okay, so all right, I'm going to go ahead and I want to look at one more thing here, and then we're going to jump to Twitter Spaces again here. So Domino's Pizza shares jumped after the company announced a third-party ordering agreement with Uber. Really? Crypto Lifer donates $20. Oh, thank you so much for the compliment there. We'll have to do some podcasts again. I got to get back in it. I kind of do those in like phases. Anyway, Domino's Pizza shares jump. Oh, by the way, who's going to the Linus Tech Expo? That's I might be there on the 30th, I think, or is it the 29th? I might be there on the 29th, and then on the 30th, you have the Tesla takeover, San Luis Obispo. Probably be at both those places. Anyway, so what do you have here? Domino's Pizza shares jump on Uber third-party ordering deal. Shares jumped after the company announced a third-party ordering agreement with Uber. The deal will allow U.S. diners to order Domino's through Uber Eats and Postmates. But, like, why is that different from just using the Domino's app? Is that really that big of a catalyst? I mean, maybe it is. Given certain customers only order delivery from Uber Eats, this deal could make Domino's available to millions of more customers. Okay. I guess I just don't see that. Like, if somebody really wanted Domino's, just do the Domino's app. Domino's app is actually really good. I kind of like Domino's a lot. Probably too much. But I'll tell you, there's nothing more fun than working hard in the office with everyone, and then pizza time, than ordering Domino's, or beer if people want it or whatever. It's fun. Okay, so there's one more thing I want to jump into, and where was it? We'll do some Twitter Spaces here. Yeah, here we go. Actually, this might take a second. Oh yeah, here it is. Okay, so here's a piece from Goldman on an analysis on AI trends at the moment. So I'd like to analyze this. So let's jump into this. AI trends, Goldman Sachs. All right, so this is Goldman Sachs. Let's see what I have here. All right. All right. Goldman Sachs just put out a piece on artificial intelligence, and we've got to talk about it because some people are wondering, is this, a buy the dip opportunity in AI? That is any chance you see a slight little red of a nominal dip you buy, or is AI going to be a fad and the projections for these AI companies are way too large? Well, yesterday we talked my opinion. Today we're going to talk Goldman's opinion. So we've highlighted some items here. And there's some talk about neural networks of the current AI tools functioning nothing like the neural nets of human brains. While AI machines can perform reflexive statistical analysis, they have little to no capacity for deliberative reasoning. This is a fancy way of saying that, there's still work to do for neural nets. So where are the most compelling AI investment opportunities today? Well, the Goldman piece argues that large tech companies developing foundational AI models, as well as the picks and shovels businesses serving the space, like semiconductor companies, cloud computing hyperscalers, and infrastructure companies, are well positioned to capture gains during the build phase. This is kind of what we've been analyzing, that you don't, in my opinion at least, or in the opinion of what we've been talking about, we don't really want to be picking software winners here. We want to be picking winners no matter which software wins. It makes me very nervous to look at software companies. So specifically when it comes to artificial intelligence. Looking at some other pieces that we specifically highlighted from this Goldman Sachs piece, we've got a neuroscience professor here from NYU. And this is really this argument about potentially the intelligence of AI systems being overhyped. And so what he's asked, is the hype around generative AI overblown? And with more context, he says yes and no. Generative AI tools are no doubt materially impacting our lives right now, both positively and negative. Generating some quality content, Midjourney, for example, phenomenal, a ton of tools. They're also generating the potential for misinformation, hacking, political consequences. In fact, the political consequences are huge. There's actually a big piece in Bloomberg right now talking about how AI is making politics easier, cheaper, and a lot more dangerous. For example, people are now generating images of China attacking Taiwan, lewd pictures of Donald Trump and Fauci making out, all AI generated, promoted by the DeSantis campaign. They're kind of funny, but they just look too real. A few weeks ago, it was claimed that ChatGPT passed the undergraduate exams in engineering and computer science, which stirred up a lot of excitement. But it turned out the methodology was flawed. And in fact, my long-term collaborator pointed out about a year ago that people still proceeded to use it. Narratives around how current AI systems will displace scores of workers, and some people are worried that robots will take over the world, but AI isn't nearly smart enough yet. 4 years ago, I joked that should you ever find yourself in a situation where robots are coming for you, just close the door. And it's still true that robots can't open doors, nor can they drive cars reliably. Well, hopefully that's getting better. This is why I still think Tesla has the largest lead here, but it's hard work. We're nowhere near achieving artificial general intelligence. Okay, that's fine. But again, even for example, what I talk about in the How to Make More Money and Get SH9T Done Faster course, big coupon expiration in 2 weeks, I talk about how even if you could use AI to boost your productivity by 15%, it gives you essentially another hour of your life back that you can now spend with family or doing fun things. And that's actually really incredible. Think about it. You have usually a workday is about 480 minutes. That's an 8-hour workday. 15% is 72 minutes. What could you do with another 72 minutes? You could study for a licensing credential. You could, go to a play place with your children. Like I like going to, trampoline parks or whatever with my kids. They really love those. It's crazy. I was actually in Utah last week, where I was in the 100th block of Salt Lake City, which is out of the city. and this mom comes over and comes running over hey, Are you meet Kevin? My husband's a course member. Ends up calling the husband. The husband comes like, Kevin. It's like, that's so awesome. It's an honor. It's really cool. So anyway, okay, great. So, okay, we get a little bit of interview chat here from Goldman Sachs. Let's get to some more of the highlighted pieces that we have here. So, couldn't the inflection point for this technology potentially occur much sooner, given the significant amounts of research and money and large companies spending money going into AI here? And this professor replies, not necessarily. Throwing massive amounts of money at the problem doesn't mean it will be solved. In 2016, I warned that driverless cars were being overhyped in the sense that solving them would prove much more difficult than many thought. That's actually ended up being correct. We've had FSD basically since, I got my Tesla in 2017, and, it gets better and better over time, but I mean, it's been 6 years. If you told me in 2017 that it would take 6 years and you're still not quite there, I'd be like, come on, it's going to be so much better even next year or 2 years. It takes a while. Driverless car systems are basically working through memorization. So when they encounter a new situation, they're often at a loss for what to do. It's actually a really interesting potential argument there. Since then, hundreds of billions of dollars have been invested in driverless cars. 2022, a Tesla summoned across a parking lot at an airplane trade show ran directly into a $3.5 million jet because, again, its training data set didn't include jets. Oh, that's interesting. That should serve as a stark reminder that just because money is there doesn't mean the results will be. This guy's an AI bear over here. Anyway, okay, so this Goldman Sachs piece is quite interesting in that you got a little bit of a bearish outlook over here. Here's somebody else. Here's another equity researcher covering, actually two equity researchers covering software and internet sectors. What do we have? So is all of this hype around generative AI warranted or overblown? And this analyst says that AI probably is not a hype cycle. This cycle hasn't been led by upstarts, which makes it less likely to fizzle out. In other words, it's led by big companies, Oracle, IBM, Intel, NVIDIA, Google, in other words. So this isn't a bubble. Broader market over the last several months on the AI themes are still trading at relatively reasonable multiples. You've got like a 3 peg on NVIDIA right now, don't you? Let me see. I mean, don't get me wrong, I'm not an NVIDIA bear, but there's a limit to how wild you can go here. Let's see. Right now, your EPS projection for the end of this year, which technically is January 31st, 2024 for them, is 773. 424 of a price divided by 773. You're looking at about a 55 PE right now for NVIDIA. However, your growth is projected at the moment to be about 25%. So actually that only puts you at a 2.2 peg. Yeah, that's not a 3 peg. That's even better than I thought. And that's assuming 25% growth. If you're closer to, you get to 35% growth, you're at a 1.5 peg on NVIDIA at today's valuation. That's actually a good point. That's a good point. While you never know you're in a bubble until it pops, the vast majority of companies that have outperformed the broader market over the last several months on the AI theme are still trading at relatively reasonable levels. Even if the hype isn't overblown, how long could it take for this technology to really have an impact on companies and workers? Well, we're in the build phase. Good analogy is thinking about the time frame it took to shift from the desktop to mobile computing. It took companies like Alphabet and Meta 4 years after the iPhone's introduction to begin referring to themselves as mobile-first companies. That's a really good point. I mean, the App Store came out, though, in fairness, in 2009. 8. The iPhone came out in 07. So one of those years, you didn't even have an App Store. and when you went to like Facebook.com, Flash video wouldn't load. That was annoying, but also quite entertaining. Productivity gains right now are concentrated at the developer level. Anecdotally, we've seen 15 to 25 or 20% boost. I think it's more than the developer level. I think most businesses and professions can get about that 15% boost. I teach all of it in the How to Make More Money and Get SH&IT Done Faster course. It's actually a really good course with a lot of really good content for a very reasonable price too. Check that out. Big coupon expiration and price increase in 2 weeks, by the way. Email us at staff@meetkevin.com for more. The build phase sounds like a lot of money in, a little money out. When can we expect companies to monetize gains? And a monetization for consumer internet companies typically occurs only once they have scale of users and deployment of purchasing power. Good analogy is the App Store, Apple and Google App Store, fine. Monetization could happen sooner for software companies. That's true. We're only about 5 months into generative AI. First 5 months of cloud computing looked like nothing, so the ability to monetize will grow. Software companies will not only have big distributions and large consumer bases, but troves of data. Well, remember, AI is really just big data, right? I mean, that was the sex appeal in 2016. Everybody's talking about big data, big data, big data, big data. You know, now it's just rebranded as AI. Any bears talking today, says someone. Nope. Take another course. Got any codes? Prepper, email us at staff@meetkevin.com, and I'll make sure McKay gets you a bundle coupon code so you get the best price. Keep in mind, if you're a multi-course owner, you can now get a pretty ridiculously discounted price on shadowing. I expect to sell out certainly within the next 2 weeks, probably for the rest of the year in shadowing, just based on what we had the first time around. And it's really just a give back to course members. Like it's really inexpensive for course members to shadow, inexpensive for course members to shadow right now. Anyway, all that's, and it's, again, it's a give back to course members. All that said, gross margins from generative AI will likely be negative for the foreseeable future as CapEx growth exceeds revenue growth. Microsoft, Alphabet, Amazon are spending more than $100 billion in CapEx. Well, this is actually exactly why I don't like investing in Microsoft, Alphabet, and Amazon, because they're literally going to call up AMD and NVIDIA, be like, yo, give me more, give me more, give me more, give me more. They got to build out their servers, because guess what Google's going to do? They're going to be like, yo, use our AI servers, not theirs. Our AI servers are better. And so as you get that, what's going to end up happening? Well, their EPS doesn't necessarily benefit from AI, whereas whose does? NVIDIA's, TSM's, ASML, and soon Intel. I still think Intel is a big play. And I wouldn't be surprised if Ubiquity can actually get into the AI move pretty well too. Pay attention to Ubiquity. It's a smaller company, but I think ticker UI. I think a lot of people don't understand the potential over there, and they're trading for under 1 peg. Continuing here, we have, it took a 10-year investment cycle for gross margins in Microsoft Cloud to go from negative to where they are today, which is well north of 50 to 60%. That's probably the baseline for AI. Oh, wow. Could you imagine that? I mean, let's even say it took half as long for AI margins to be positive. That's going to be a while. Wow. That's going to be a while. Okay. Wow. Semiconductor companies and the hyperscalers and cloud computing also look well positioned to capture gains during the business cycle. Okay. Wow. All right, so let me see if there's any other leftover commentary here. We have a little note written here. Let's see. Goldman piece. You're really getting various perspectives about whether or not this is a bubble. Some think it's a bubble, but the consensus is pretty much it's going to take a while to earn money from this, especially during this build phase. But the picks and shovels like NVIDIA and of course the chip builders will likely continue to benefit here. So very exciting. Okay, that's very insightful for the for Goldman piece here on AI. Pretty much, I mean, I hate to say it, but it feels like it somewhat reiterates what I've been saying. And I always think that's dangerous to look at pieces that reiterate what you're saying. You're supposed to kind of look at the opposite things because of the problems of confirmation bias. But whatever, you saw it from them, not me. So, okay, let's get to some, let's go to Twitter Spaces. So I've added some folks as speakers here. The microphone is on. Somebody give me something
Kevin.
from Twitter Spaces. What's up, man?
Hey, how's it going?
Great, man.
First of all, I wanted to say thanks so much for doing your videos and putting all the information out there. I don't really come from a financial background, but as of the last 2 years, I'd say after COVID, I've pretty much gone all in on Tesla stock. And 2017, I dabbled in Bitcoin, and that's pretty much gotten me to where I am now. almost financially free at the age of 33, and kind of going against everyone's advice to sell my stock and my Bitcoin and buy some real estate, but I just can't do it.
Wow, that's amazing. So where do you want to buy real estate?
Sorry?
Where do you want to buy?
Well, I live in Sydney, Australia. I don't know if you know anything about the market here, but it's pretty up there, overpriced, I think.
Well, people want to be in Sydney. I think you guys are actually, I'm not sure if you're part of the Mediterranean climate, but your climate's pretty great over there. You've got, I wonder how your population is doing, if y'all are, what the growth is like over there. I expect it to be good. I don't know, I got to look that up a little bit. What do you know? How's your growth been over there?
Yeah, I think on average you get about 10 to 12% a year.
That's incredible.
But yeah, I mean, in the area where I live, the growth's been insane. I mean, pretty much through COVID, everything kept growing. There was a bit of a lull this year, but I think everything's on the up and up again. But I mean, from my perspective, I can't see any good reason for me to get out of either Bitcoin or Tesla stock to kind of dabble into real estate. What do you think?
I see. Okay, so you're saying you're actually holding on to those, is what you're saying?
Oh yeah. Yeah.
I think there's still some legs for both of those. I think there is a good chance that once people are convinced that inflation was transitory and this Nike swoosh ends in a euphoric cycle again, where people are like basically Tina, buy Tesla, buy Bitcoin, whatever. I think there's a good chance that you get to euphoric pricing for both, which could be all-time highs for both Bitcoin and Tesla. And I think that is going to be closer to the time where I say, okay, I start selling some of my Tesla, for example, and throwing that straight into real estate. But I don't know that time is now. I agree with you. I think there's still a cycle ahead of us.
Yeah. I mean, with Bitcoin, for sure, I know that mania phase is going to come, and I'm expecting that to come in about 2 years. I've been in Bitcoin since 2017, so I've pretty much lived through to 75 to 80% drawdowns. So I know what it feels like, and it's not fun. And hopefully this year, in 2 years' time, hopefully I get out in time. And who knows, I'm going to have a look at where Tesla stock is within 2 years and make a judgment if I kind of dabble into real estate. But for the meantime, I mean, my conviction on both is pretty huge.
That's awesome, man. Good job. Well, congratulations. That's super cool to hear. Folks, we are I'm going to go ahead and mute space now. We got to run over. We're going to do this again tomorrow for our stream. We'll have spaces going again. If you've watched this on YouTube, as always, thank you. Twitch, thank you. If you watched it on Twitter Live, leave a comment. How was it? Twitter Spaces, leave a comment. How was it? I'd like to keep it regular and going, so we'll see. Since we're live anyway on YouTube. I've got to run over to the course member live stream now. I'm going to go make another cup of coffee. We'll be right there. So thank you so much for being here, everyone. And I'm going to go ahead and end these now, and we will see you soon. Thanks so much. Good luck. Enjoy CPI Day, and goodbye. Check out those courses on building your wealth. Next coupon expiration in 2 weeks, and you can now shadow if you're a course member for a big discount. Go to meetkevin.com to learn more. Goodbye.